Hello and welcome to the Killik & Co podcast for Friday the 19th of February 2016. Equity markets had a poor start to 2016, reaching a 3.5-year low in the FTSE 100 last week. This has been driven by fears around things like the Chinese currency policy, low oil price and the impact that's having on equity markets, fears over the direction of the US economy and interest rates, as well as a feeling that the ECB hadn't been strong enough in its actions taken in December. However, since then we have seen a bounce in equity markets, with the FTSE up around 8% since last Thursday, and you can see the bounce there in the chart. Looking at China, over the past week we have seen improved inflation data coming out of China, both on CPI and PPI, and it can be seen in this chart over here. And we've also seen positive commentary coming out of the Chinese central bank, where they made it clear that they don't feel there's a need for any type of capital controls, and they also don't feel that there's a need for any further devaluation in order to boost Chinese export competitiveness. We've also seen the impact of the weak oil price this year after falling 35% last year, and this has impacted earnings coming from the oil producers as well as related industries, and has also caused investor fears over the impact on banks' balance sheets from losses in loans to oil producers. But the past week has seen the first signs of OPEC and non-OPEC cooperation in order to boost oil prices, and it's been about 15 years since we last saw this, and this has seen an improved picture on the oil price as well as boosted investor sentiment in equity markets. In terms of the US, investor fears over the economy have been tempered by bullish by more dovish Fed minutes, as well as comments made by the St. Louis Fed President Bullard, who's usually a hawk, who said that it would be unwise to continue hiking interest rates given the declining inflation expectations and the recent equity market volatility. In addition, industrial production in the US, the data was better than expected and was up 0.9% on a month earlier versus an expectation of 0.1%. We can see the bounce that we've seen in the year-on-year industrial production number there. In Europe, fears that the ECB didn't do enough at its December meeting were addressed in the minutes of the January policy meeting. And the Governing Council was unanimous in concluding that its current policy needed to be reviewed and possibly reconsidered in March. Markets are now expecting the ECB's deposit rate to be cut by a further 10 basis points to minus 0.4% next month, continuing the negative interest rate policy that has been in place since June 2014. You can see that on this chart over here of the ECB deposit rate. There's also expectation that QE might be further increased at the next meeting. Just looking at some of the recent results and news coming out of companies. So HeidelbergCement reported last week, results beat expectations. We continue to like the story there based on its ability to benefit from increased cement consumption in the US and UK, driven by both residential construction as well as infrastructure spending. It also stands to benefit from its recent takeover of HeidelbergCement, and they've raised the level of synergies that they expect from that deal. The TripAdvisor reported last week. There we continue to like the story, given the fact that it's seeing a move to more transaction-based revenues instead of advertising-based revenues, as more online travel agents and hotel chains and hotel groups move on to using its instant booking function. And we continue to believe that it has an unrivaled review database, which is a very important tool for both for consumers when making both travel bookings as well as other leisure activity and restaurant bookings. And then Vodafone this week announced a joint venture with Liberty Global in the Netherlands, and they're going to be combining their mobile operations with Liberty Global's broadband operations. We see this as a very good strategic move, as it recognises the fact that consumers are looking for a more unified telecoms offering as there's a greater demand for data capacity. So they want both mobile and fixed operations from the same supplier. Just looking at the week ahead, it's quite a busy week in both UK and European results. Two that I'll just draw attention to is our HSBC and Airbus. So looking at HSBC, we think there's two issues that the market's likely to focus on. The first will be what they say around credit conditions, especially in China and oil-related, given the fact that HSBC is such a large trading bank with strong positions in Asia. And also we believe that there will be some focus on what is happening in terms of cost-cutting programs that HSBC has announced, because analysts haven't really given the company much credit for that in terms of their consensus expectations over the next few years, given the company's poor track record in achieving cost savings in the past. Moving on to Airbus, we would expect it to report good numbers next week, given it's previously guided to its level of deliveries in 2015. We think investors will likely focus on the cash flow, given that management have announced fairly specific targets around cash flows, both at the group level and at individual product levels. In terms of areas where there might be some risk of disappointment, well, there could be a risk in the helicopter side, where a low oil price may continue to impact demand for helicopters there. That's all for this week. Thanks very much for watching.